السلام عليكم ورحمة الله وبركاته. حياكم الله جميعا معنا في أحد الندوات الأكاديمية المالية وهي and I would like to welcome you all. This is Ibrahim Al-Khayfam from the Financial Academy. Speaking about the Financial Academy is one of the initiatives to support the vision of the Kingdom of Saudi Arabia 2030, and to close the gap in the financial sector and to prove your skills and your knowledge as well. Today, we have one of the instructors with the cooperation with Zishi Training Center from UK, Mr. Simon Hart, who will be delivering one of the webinars, which is an introduction to future and options. He has a quite good experience with this field. I would like to welcome Mr. Simon.
Hello, nice to meet you.
Nice to meet you too, thank you. I leave you right now with this webinar. I hope that we reach your expectations, and wish you all good and wonderful journey with Mr. Simon. Wish you all
fantastic.
The best. Thank you.
Thank you very much, Ibrahim. That's greatly appreciated. So yes, well, first off, let me bid you a welcome to this presentation. So as Ibrahim just said, my name is Simon Hart, and today I'm speaking to you on behalf of the Saudi Financial Academy. It's a great honor. I'm also speaking for Zishi, the derivatives educational company. So Zishi runs all kinds of training programs in trading for many of the world's largest financial institutions. A lot of the courses are accredited by top universities, and Zishi also provides postgraduate diploma qualifications for financial executives and indeed for private investors, and that's globally. So before we start, I'm just going to give you a brief bit of background on me personally. So I started out many years ago working at a bank, and since then I've worked as a derivatives trader at an option market making firm, at a hedge fund, but over the last few years I've purely been teaching and speaking on the subject of trading, and that's with specific reference to derivatives. So I'm an ex-trader, and in my trading career I had experience of trading a variety of asset classes, from equities, stocks and shares, that is to say, to commodities, raw materials, bonds, government bonds, and indeed currencies. But as I just mentioned, these days I'm a full-time trainer and I'm a consultant too. So until the end of 2019, I was traveling the world providing education on trading. But obviously the COVID pandemic changed the way we work. So for the last few years, we've been delivering all our education in this way on Zoom or other channels. But I'm pleased to say that's changing though, very pleased to say that. So I've traveled to Europe recently to deliver training, and I'm very much hoping to visit Saudi Arabia in the near future. I think the developments in financial markets in your country are extremely exciting. And like so many other areas of life, it is evident that Saudi Arabia, the Saudi Exchange, the Saudi Financial Academy is at the forefront of new initiatives and amazing opportunities. So in this session, excuse me, I'm hoping I can offer some insight to the world of derivatives trading. But it goes without saying that in the short amount of time I've got available to me today, I can only cover so much ground. This is a truly massive subject. I mean, truly, truly huge. And it's absolutely fascinating. I guess I would say that, but we can only cover so much ground. And so we'll definitely need more time with you at some stage in the future to really dig deeper. But anyway, let's get going now. So let's open with this word derivatives. The derivatives markets are huge, multi-trillion huge. So let's be clear on the meaning of the word derivatives itself. So a derivative is an arrangement or product whose value derives from and is dependent upon the value of an underlying asset, such as a commodity, a currency, or a security. By security, I mean a stock, such as those stocks listed on the Saudi Exchange. Now, I think a key word not mentioned in the opening definition is contract, but it's important to understand that that is what a derivative is. They are contracts agreed between two counterparties for the future delivery of a commodity or other assets. So the contracts are not executed face-to-face by the two counterparties. No, they're executed anonymously on an exchange, on a trading screen, such as Tadawul, the exchange we're here to talk about today. But nonetheless, it's important to understand that derivatives are contracts for the future delivery of an asset. And those contracts have a price and a value. And this is the key point. They are tradable. So we've got several different types of derivatives. We've got future contracts, we've got option contracts, and there are swap contracts. Now today, we're going to concentrate on future and option contracts. We're going to start with futures. Now, virtually all listed derivative contracts were designed in the very first instance to allow companies to price hedge. But what do we mean by those words listed and price hedge? Well, the word listed has the same meaning as when we talk about shares listed on a stock exchange. A listed future or option contract is available for trading on an exchange, and that opens up a lot of possibilities. Okay, so what about that term price hedge? What did I mean by that? Well, hedging in the world of trading means protecting ourselves against adverse price movements in an asset, hedging ourselves against exposure. So, for example, we'll be able to use stock futures and options listed on the Saudi exchange to protect our investments against adverse price movements. It's not their only purpose, but it's their primary purpose. Okay. Now, in the world of investment and trading, there are three main asset classes. So we've got commodities, that's to say raw materials like gold or crude oil. Then we've got equities, the stock market, very relevant and pertinent to today's discussion. And then we have the asset class of fixed income, which means the bond market, the global bond market. And we can go into greater depth on these subjects in later sessions, but principally we're talking about government bonds there, and they're very big asset class. Now, these asset classes don't act independently of one another. Even though the commodities market and the equities market are smaller than the fixed income market, the price of commodities can affect the fixed income market because higher commodities prices can cause inflation, which has an effect on interest rates, which affects the bond market. And higher or lower interest rates can affect stock markets. And I'm not just talking about long-term trends here. This connectivity is happening minute by minute. So this is a big point I really want to make in this introductory session. Everything in this world of trading is connected. Understanding that principle, I believe, in this first session, will help you to engage with and use the derivative products that are being launched on the Saudi exchange. So, now the kingdom, Saudi Arabia, the kingdom is arguably at the connecting point of the asset classes mentioned on that last slide. And we'll learn more about the connected global kind of ecosystem later in this presentation, with specific reference to Saudi Arabia. Now, the traders I know and have worked with think in terms of a matrix, a trading matrix, and they plot where various assets or securities are on that matrix in order to observe any relationships that are converging or diverging, and their kind of convergence or divergence that we may be able to capitalize upon. And I will show an example of that with direct relevance to you later on. So, as you are, of course, aware, as citizens of the country, the kingdom produces the world's single most important commodity, crude oil. I teach a lot on crude oil. We're always being asked about that commodity because it's at the epicenter of the trading universe. So, the Saudi exchange also lists Aramco, the stock Aramco. And of course, that's related to crude oil, very clearly so. Now, the Saudi exchange also has a debt, a bond market. We can see little screenshots from the exchange website there. The Saudi exchange is introducing a range of derivative contracts, a very exciting development. And now we're going to start to think about joining up a few of these elements. But first, let's go through the proper definition of a future contract. I think we need a bit more detail before we move forward. By the way, in case you have any questions that arise during the presentation, I think we're doing a little Q&A at the end of this, but we'll see how it goes for timing. So, I've spoken in general terms about derivatives, but let's drill down a bit and look at a specific type of derivative contract, a future contract. So, a future contract is a legally binding agreement to buy or sell an asset, such as crude oil, gold, a stock market index, an actual stock, at a price agreed now, but with delivery of that asset taking place on a specified date in the future, via the click of a mouse on a trading screen. Now, they're called future contracts because the delivery date is in the future. Pretty straightforward, right? We abbreviate buying or selling future contracts to simply buying or selling futures. So what I mean by that is when we execute a contract to buy the asset at a future date, we say we have bought a future. That's the language of the market. When we execute a contract to sell the assets, to deliver the asset at a future date with the price agreed now, we say we have sold a future. It can be a little bit confusing initially, but that is the language of the marketplace. So that specified date in the future on which delivery will take place is known as the expiry date, which we always abbreviate to simply expiry or expiration. That date is a standardized feature of futures contracts, and it's set by the exchange itself, not the counterparties to the trade. Now, I'm going to speak more about standardization in a few moments. We'll also see some examples of expiry dates in a moment when we look at some futures prices. Something else that it's important to know is that professional traders don't refer to contracts. We use the word lots. So if a trader buys one contract, for example, he or she will say, I have bought one lot. If a trader buys 10 contracts, he or she will say, I have bought 10 lots. Just the language of the market. There's no rules or regulations over that. It's just terminology you may hear, and I just wanted you to be aware of that. Now, right up to expiry day, futures contracts are tradable assets, tradable securities. That's to say, when you've bought a future contract, you can sell it on to someone else if you wish. It's only on the date of expiry in the future that delivery of the actual asset takes place. Until that time, they are simply contracts that increase or decrease in value, and they can be actively traded. By the way, the price of a futures contract is expressed pretty much in the same way as the price of the asset itself. If we look at a stock market index future, such as the S&P 500 in the USA or the MT30 index future that trades in the Kingdom, we'll see they look virtually identical to the actual cash stock market indices. By way of another example, the price of a crude oil future contract is expressed in dollars and cents per barrel. So we have two choices when we enter a future contract. We can either hold that contract all the way to the expiry date and become involved in the delivery of the physical asset, or we can pass that contract on to someone else in the marketplace at either a higher or a lower price. We call that trading out, by the way. Now, an increase or a decrease in the price of the asset is entirely dependent on market forces. And obviously, we try and get our judgment correct. Okay. So, as I just said, we can see the definition repeated on the screen now. A future contract is an agreement to buy, to take delivery, or sell, to make delivery, an asset for delivery on a fixed date in the future with the price agreed now. All futures contracts are designed, specified, and standardized by the relevant exchange. It can be a Western exchange in the US, CME, or ICE Intercontinental Exchange, or it can be Tadawul in the Kingdom. It can be Eurex in Germany. But the exchange designs and specifies the contracts. Okay. So this means as traders, we can just click on the screen or instruct our broker to buy or sell a future contract. We don't need to think about anything other than the price, because we will be trading the same contract specifications as everyone else in the marketplace. So let's look at the official contract specification for the ICE exchange Brent crude oil future contract. Just by way of example, I think it's good to talk about commodities when we first start talking about futures, because it makes it really easy to understand them. As I say, crude oil is possibly the most important asset in the world. So we're looking at the official contract specification for the ICE exchange Brent crude oil futures contract. Screenshot on this current slide, you can see it here. Just in case you don't know, the word Brent refers to the oil field in the North Sea by the UK. It's a tiny oil field, in actual fact, much smaller than the oil fields in the Kingdom, obviously. But it's the global benchmark for pricing crude oil. Strange as it may seem, crude oil that comes out of the North Sea of the UK represents the global benchmark. Now, every Brent crude oil future contract that is executed between a buyer and a seller is for delivery of 1,000 barrels of crude oil. You can see it mentioned right there. That's for delivery of 1,000 barrels of crude oil in the future. That's to say, upon expiry date of the future contract. Now, at the bottom of the specification list, you can see it mentions a minimum price fluctuation. That, it's down here, just let me highlight it with my mouse again. This is the minimum increment by which the price of crude oil futures can move. It is 1 cent per barrel. By the way, futures traders call the minimum price fluctuation a tick. Again, that's more language from the marketplace. It takes a long while to say minimum price fluctuation, right? There's no time to say that in a busy trading environment, so we call it a tick. And that's applicable to all futures contracts universally, and there are thousands of futures contracts. It's the language of the marketplace. It's another example, this minimum price fluctuation and this tick, of the standardization of future contracts. Now, to be clear, the price of crude oil futures can move a lot more than 1 cent per barrel or 1 tick, but it can only move in increments of 1 cent or 1 tick. Now, the profit or loss on a 1 cent move on one crude oil future is $10. So if you buy one crude oil future and the price of crude oil goes up by 1 cent per barrel or 1 tick, you make $10. If it goes down by 1 tick, you lose $10. Now, as I just said, one of the reasons I've chosen crude oil as a futures contract example, even though it doesn't trade on the Saudi exchange, not yet anyway, let's keep our eyes open for that, is that it's a commodity we all recognize. And also it's very important to the world economy. And it's very important to all traders, even if they aren't directly trading it. Now, we can buy or sell multiple contracts if we like, just as we can trade as many shares as we like in the Saudi stock market. However, buying or selling futures does not mean we will ever actually get involved in the delivery of the asset in question, in this case, crude oil, because futures are tradable contracts. Very few traded contracts remain open by the time of expiry. In my trading career, which is a long time ago now, I'm getting quite old, I've traded millions of barrels of crude oil, thousands of tons of coffee, millions of tons of wheat and soya beans, thousands of ingots of gold, hundreds and hundreds of millions of government bonds, but I've never actually been involved in the delivery of any of those assets. That never really happens in the futures market, so don't be intimidated by that. Everyone trades out of their contracts before we reach the moment of expiry. Okay. If we buy a crude oil future and then sell a crude oil future of the same delivery month, we won't have any outstanding contracts. And this applies to stock market index futures too on the Tadawul exchange. A buy and sell of the same asset in the same expiry month cancels one another out. We will just be left with profit or loss, depending on whether we bought at a lower or higher price than we sold. Okay, this is a screenshot of some live prices from the 30th of August, a couple of weeks back. I took the screenshot a couple of weeks back. This data is available to us. I just need to tell you via a service called ICE Connect, by the way. ICE Connect is a similar service to Bloomberg or Reuters. You're probably all familiar with those names, Bloomberg and Reuters. They are what's known as quote vendors. We use ICE Connect. It's a lot cheaper than either of those, and in my opinion, it's a lot better. Now, let's just go through what a futures contract looks like. Let's look at the top row. So I'm just looking away to look at my monitor here, excuse me. There's a lot of data on here, and I realize for people who are new to this, this can be quite intimidating. So we're just going to look at one row. Up the top here, can you see Brent crude future? We're just going to look at a couple of these columns here. We've got the bid and ask column. So the bid price at the time I took this screenshot was the best buying price for crude oil in delivery in October. So all these different rows represent a different expiry month. The top one represents October 2023, then it's November 2023, then it's December 2023, and so on. We're just concentrating on this top row. The best buying price at the time I took this screenshot was $85.25 per barrel for October delivery. And the best selling price, the offer price, which we also call rather confusingly the ask price, was $85.27. There's lots of other information on that screen that you can see there, the high and low of the day, the cumulative volume. But I just wanted to give you a quick snapshot of what a futures market looks like. So that's crude oil. Okay, now, having established the basics of a futures contract, using a commodity as an example, and a commodity that's very important to the kingdom, of course, we can now look at another example, one that is very pertinent to you. It is the MT30 future, the future contract based on the MSCI Tadawul 30 index, and it is listed on the Saudi exchange. The most important point to note is that unlike a commodity future, unlike that crude oil future, this stock index future is what is known as a cash settled future contract. So at the moment of expiry of an MT30 future, there is no delivery of the 30 constituent parts of the Tadawul index. That's to say 30 shares. No, upon expiry, there is simply a final calculation of profit or loss based on the value of the cash index itself. This is in line with stock index futures elsewhere in the world. It's how it works everywhere. So the Saudi exchange is following a very good established model here. Now, can you see at the bottom of the table, showing the of the contract specification here? It's abbreviated, by the way, where it says minimum price movement. It actually uses the word tick again. That is telling us that for every index future we buy or sell, we will make or lose 50 Saudi riyals, I hope I'm getting that pronunciation correct, for a half-point change in the MT30 index. Now, the convenient thing about an index future is that you can gain immediate exposure to the broad Saudi stock market without having to trade the full basket of stocks that makes up the index. You can just buy one index future and you've got exposure to the broad Saudi stock market. Now, I suppose you might say that's true of exchange traded funds, ETFs, but index futures are more transparent. And it's also much easier to change your decision about your position and simply turn it around in a matter of seconds if you wish. I mean, in my trading career, and again, referring to traders I know now, sometimes we'll be in and out of a trade in a minute or even less. Now, I'm not recommending that, and I'm not saying it's something that you would do right now, but it does sort of re-emphasize the immediacy of futures markets. They're incredibly accessible. And unlike what can sometimes be the cumbersome process of investing in funds and so on, futures are very immediate, highly liquid, and very maneuverable. So futures are ideal for long-term trading and indeed very short-term trading. Okay, so there is our Saudi index future. Now, really important point this, and really fundamental, this next point to trading futures. You can see the heading to this slide, futures, unique advantages. One of the main differences and advantages of futures over traditional assets like shares is that as speculative traders, or indeed hedgers, investors or hedgers, we can of course buy futures, which we call going long, but we can also take short positions. We can go short. So in other words, with futures, we can sell something we don't own and buy it back later. It's a really unique advantage. But how is that possible? How is that possible to sell something we don't own? It sounds crazy to people who are new to this. And apologies if you know this already, but for people who are new to this, it sounds like a really crazy concept, right? Well, remember, delivery of an asset with a futures contract takes place on a date in the future. For example, right now, we could sell crude oil for delivery in December by the simple act of selling a December future contract at the prevailing market price. We don't have to own any crude oil to do that. So long as we later buy a December expiry crude oil future contract before we actually reach the expiry moment, we won't become involved in the delivery process. The sell and buy contracts cancel each other out, and we are simply left with a profit or loss. So this means we can make money from falling prices, assuming we get the market right, of course. I mean, that's a very important qualification. Just as a little aside, you might be interested to know, I can remember when I first started trading commodities, I was always terrified about thinking, well, suppose I forget I've got a contract open and I accidentally take delivery of gold or crude oil. How will I do that? Well, it's just impossible for that to happen. There are so many safety checks in place, from the exchange risk department to brokerage to all kinds of, a whole risk waterfall, if you like, making sure that doesn't happen. Anyway, short selling, being able to go short via futures contract is a massively important advantage. I think short selling can sometimes have a bit of a bad name globally, and that's completely wrong idea. Short selling keeps markets in balance. Sometimes markets can get inflated. Being able to short sell a market means that we can stop asset bubbles arising. Now, the principles of short selling applies to the Saudi MT30 index future too. We can go short of the Saudi index if we choose to do so, and thus benefit from a falling stock market. Again, assuming we get our timing right. One of the big principles and themes I like to concentrate when we talk about these things at an early stage is about not being a victim of market volatility, not being exposed to all kinds of market conditions. Derivatives allow us to benefit from falling markets as well as rising markets. So we've got essentially two motivations for trading futures. We're either using futures to hedge a current existing price exposure, or we're using them to speculate or to invest. I realize that word speculate and speculation can sometimes have a negative connotation. And again, I think that's inaccurate, but understandably, that globally, sometimes it can have a negative connotation. So we'll talk about speculation, investment. They're pretty much the same thing. But the two motivations for trading futures are price hedging or speculation. Now, as I've already mentioned, future contracts originated for the purpose of hedging. Hedging in the world of finance means removing price risk. By way of example, let's say you own a broad selection of Saudi stocks, and let's say you've been invested for some while. Well, one look at this chart on the screen here, which I actually took from the Saudi Exchange website, shows that if that were the case, you've been doing very well overall. But let's say you are now concerned about a fall, a correction in the stock market. And by the way, I'm not saying that's coming. I'm just teaching here. It's just an example. Let's say you were becoming concerned about a fall in the stock market. What would you do? What can you do? Well, of course, you could liquidate your entire portfolio of stocks, but that could take quite a lot of time to sell a whole basket of stocks. Plus, it may have tax implications. And also, it would mean you were no longer invested in the stock market. So what could you do instead? Well, what you could do instead is go short of, sell some MT30 index futures. If the broad stock market were to then fall, the profit you would make on your futures position with your short futures position would offset the losses in your stock portfolio. It's a hedging exercise. Now, again, I sort of said this is a very deep subject. It takes a bit of strategy and planning. The really important things with using derivatives is strategy, discipline, resilience, planning. There's a lot of personal elements and skills that will help you use these things well. And I suppose one of the choices you have to make is, do you hedge your entire portfolio, if indeed you want to hedge? You could just hedge part of it. So that's part of strategy that you need to decide for yourself. It's going to depend on your attitude to risk and your view on the markets. Now, it must be said that if you 100% hedge your portfolio by selling the appropriate amount of Saudi index futures, you would also cap any further upside potential on your stock portfolio. But you might just have the future position on for a brief period until your confidence in the market returns. Now, hedging an equity portfolio is not the only reason why someone might take a short position in MT30 futures. It might be that you have no exposure to the underlying market at all, and you simply have the opinion that the stock market is overvalued, and you believe a correction is due. Like I say, it's just an imaginary scenario. I'm not saying that's my opinion. It's not my opinion at all. But if that were your opinion, you might then make an investment decision to take a short position in index futures to capitalize on the fall in the market you believe is coming. Now, very important what I'm about to say. If you do take a speculative short position in stock index futures in Saudi Arabia, it is very important that you're disciplined. If it turns out that your view on the market was wrong and the stock market continues to rise, professional traders use something that we call stop loss orders. You may already be familiar with those. Professional futures traders use stop loss orders entered into the market to exit their positions should the index price go against them by a certain amount. Now, if you're not familiar with the concept of stop loss orders, you should speak to your broker and find out more about how they work. Using stop loss orders does not mean you won't lose money, but they will put a limit on how much you can lose. They're a very important part of your armory, your toolkit when you're trading futures. And you can use stop loss orders when you have a long position or a short position. Okay, on to another point. Traders do not have to pay the full face value of the contract upon execution. That's to say, the opening of a future contract. A trader is only required to post something called initial margin. So initial margin is the amount paid by both the buyer and the seller as a deposit, a security deposit, collateral at the time of trading, the time of opening a contract. Now, depending on the product, initial margin typically varies between 5% and 20% of the value of the contract. Those numbers aren't definitive, it's just an indication. Now, initial margin is credited back to the trader's account once a futures position is closed or expired. Now, it is the clearinghouse, and in Saudi Arabia, that's called Makassa, that holds the initial margin, that hangs on to that initial margin. I do hope I'm getting my pronunciation correct there. Do forgive my Western inabilities in that regard. Hopefully I'm getting it right. Now, it's not just the Saudi index futures this applies to, by the way. This is how it works for all futures contracts globally. Trading on margin, as we call it, is one of the great advantages of trading futures. It's important to understand that a trader is exposed to losing more than that initial margin, but that is the initial security deposit that is required to open a futures contract, and it's far less than the face value of the contract. The trader, a trader, an investor, will have an account with a clearing member, your broker, probably the same broker that you use for your stocks and shares trading. And it is the job of that broker to handle the margin payments between you, the trader, the investor, and the clearinghouse, Makassa. So let's talk about the Saudi clearinghouse. Now, I've quoted directly from the Tadawul website on this slide, so let me just read from it. So the Securities Clearing Center Company, Makassa, again, I do hope I'm getting that pronunciation right, certainly hope so, was established in 2018 as a closed joint stock company fully owned by the Saudi exchange Tadawul. So Makassa is critical to future market infrastructure by enhancing market efficiency and enabling Saudi market expansion into new products and services. So Makassa reduces post-trade risk, provides a centralized counterparty risk management service, and it develops clearing services in accordance with international best practice. It's a very important part of this picture. So it's that third bullet point that's of interest to us today. Makassa acts as the central counterparty to all open future contracts, thereby removing the risk of default, removing counterparty risk. By holding initial margin from both sides to an open future contract, the clearinghouse can guarantee that if you make money on your futures position, you will get paid out. And that's very important, right? You don't run the risk of the other side defaulting. This is why the clearinghouses globally are known as the central counterparty. They play a really important role in preventing systemic risk. They prevent a counterparty risk. They control it. Okay. So given that you do not have to pay the full face value of a contract, also known as its notional value, its face value is known as its notional value, this means that your capital is used efficiently. You don't have money wrapped up unnecessarily. It also means that you can gear up or leverage your trading capital. We tend to use the word gearing in Europe. I'm UK, Europe based, and the Americans tend to talk about leverage. I'm not sure exactly which term you'd use in Saudi. But what we mean by that is for a given amount of capital, you can buy or sell more futures than the equivalent underlying asset. For example, for a given amount of capital, you can gain greater exposure to the Saudi stock market through trading futures than you can through trading cash equities, because with futures, you are simply posting margin. Okay, so given that we can gear up, given that we can gain leverage, we can accelerate, we can multiply profits on correct trading decisions. But it's very important I say the following: it can do the same with incorrect trading decisions. I think when we're teaching on this subject, it's very important that we don't praise products too much. As with all trading, there are dangers, there are risks, and it's very important to highlight those. It's imperative that on the first day you start trading futures, you don't use a huge amount of gearing or capital. Trading is a learning process. You know, we learn from mistakes. We can help you with this. We can provide many more training courses, but also you need experience, and it takes time for that. Okay, start small. I'll probably get in trouble for saying that, but nonetheless, that is my recommendation. Risk management and discipline is of paramount importance. At Zishi, we speak about developing resilience. We speak a lot about discipline. We teach on those subjects. It's those elements that make you a good trader. Now, so it's very important to understand that gearing and leverage can work very well for you on good decisions, and that's a great thing. And in my trading career, which is many years ago now, it served me very well. But also leverage and gearing, if you employ it, can hurt you when you are wrong. Now, positive gearing can be achieved more effectively through options, in fact, and we'll talk more about that subject very soon in the kind of second half of this presentation. So yes, gearing, leverage, very important elements of trading derivatives, because we are, to paraphrase, we are trading on margin. We only have to post margin, not the false face value of the contract. So as I said earlier, one of the other main differences and advantages of futures over traditional assets like shares is that as speculative traders or investors or hedgers, we can of course buy them, which we call going long. That's the word we use. We've gone long, but we can also take short positions. We can sell something we don't own and benefit from falling prices. Now that's assuming we get it right. Short selling, you know, isn't just a free way of making money. Of course not. It's misunderstood by a lot of people, especially in the sort of global mainstream media. But, you know, short selling is a great advantage of derivatives. And like I say, it's a very good thing, I think, for capping bubbles in markets. But it's not, you know, it's not a license to print money. You still have to get it right. It's very important to say that. But anyway, there are more advantages here. And this is what I want to start digging into now. And this is very much the view of the professional trading market that I'm about to speak about, how the professional hedge fund, bank, proprietary trading firms approach markets. We can trade futures spreads. But first, that word's not going to mean a lot to you in the context of derivatives. Spreads are sometimes known as strategies in our world. The two words are interchangeable for our purposes. A future spread is when we take on a long position in one contract and a short position in a related contract. And this brings me back to my earlier point that I was trying to make to you right at the start of this presentation. About everything in the global markets being connected. There is this ecosystem that works in the markets. Again, with the greatest respect to the audience in the kingdom, you may well know this. So forgive me if that is the case, but it's really important as traders and investors, you understand that everything is connected. Nothing really works in isolation. We've always got to be looking outside of the specific thing we're trading. It's incredibly important. I'm going to talk through an example of that now, because well, not only does it protect us, but it opens up opportunities, especially in the world of derivatives. So on this chart, which may be bewildering when you first look at it, and again, this chart is courtesy of ICE Connect. On this chart, we're looking at the price of Brent crude oil futures. They're in the red line. And we're also looking at the price of the Aramco stock price in the black line. Now, there's not really maths on this and no statistics. It's just a kind of overview. It's ideas generating, right? The example I'm about to go through. So this chart is looking back over about 1 year. Now, I would sort of say that you can see there was a fairly good, strong directional correlation between the two prices. That's to say the price of crude oil in red and the Aramco stock price. We can say they kind of go down together and they kind of spike up together. And there's a decent relationship. Look at the rally here in crude oil, the rally in Aramco. Okay. Every so often, though, that correlation breaks down a little, and that presents an opportunity. If you look towards the bottom right of the chart, you can see that crude oil in red here trailed behind the Aramco stock price for a while. And that period is the kind of thing that presents a strategic trading opportunity to the eagle-eyed. What a derivatives trader might have done during that period of divergence of the two prices, is buy crude oil futures and simultaneously go short of Aramco single stock futures in the belief that the two would converge together at some stage, that normal behavior would be resumed. What we're doing here is trying to be more strategic in our thinking and also reducing our risk. Long-short strategies, if we observe normally correlated products, can help reduce overall risk exposure. Now, you can indeed see that this is how things played out. As I say, I'm oversimplifying here. It's very important to say that. I'm talking about a general theme that I'd really like to communicate about derivatives trading that's presented to us by the fact that we can take short positions and long positions. The fact here that we could take a simultaneous long position in crude oil and a short position in Aramco futures isn't reflecting a view on either of those assets in isolation. It's reflecting a view on the relationship between the two. So you can see it's strategic, okay? And that's what we're trying to emphasize about here, about a professional approach to these markets. Now, and indeed, normal service was resumed. We can see that through buying crude oil futures and at the same time being short Aramco futures, that convergence that we can see here, that divergence that we can see here went to convergence, and that would have been what we call a profitable spread trade. Now, as the price of Aramco shot up here, sure, you would have lost money on your short position in Aramco futures, but you would have been making money on your long position in crude oil futures. And it's the difference between the two that we're concerned about. So that's a spread trade, the sort of divergence of a normal relationship here, and then looking for a convergence of that normal relationship. That's just a little bit, first look, if you like, amongst the thousands of possibilities that there are with regards to strategic spread trading. And all that's made possible by the fact that we can go short in the world of derivatives. So that's one historical example of what we call a spread or strategy in the world of futures trading. That trade would not have been a simple bet on crude oil or Aramco, as I said. Now, a trader would have to do some calculations to decide on the ratio of Aramco futures to crude oil futures. But at the moment, I'm just making a general point, thinking globally. Let's move this subject of spreads on a little. So we're now looking at Brent crude futures on the ICE exchange again. Once more, this data is courtesy of ICE Connect. And once more, we can see all the different prices for the expiry months, all these rows. I am fully aware that, the audience that's watching today is very well informed and very intelligent, but nonetheless, when you first see data for the first time, it can be really confusing. Of course, it can, even for the most academic amongst us. So it's my job to try and simplify this a little bit. I had to learn this too. There's a lot of choice here. There's a lot of choice with derivatives. So we're just going to have a quick look at the data in the top row. Again, that's the data for the October 2023 expiry futures at the time I took this screenshot. Once more, these are crude oil futures. Under the bid column, you can see the current best buying price at the time, $85.25. And under the ask offer column, we can see the selling price of $85.27. Let's move along to the columns that have the headings high and low. You can see them here. The high price of the day in October futures at the time I took this screenshot was $86.23. The low price at the time I took this screenshot was $85.11. So let me see, that's a difference of $1.12. So we have what we call on that day so far a trading range of $1.12. If we look at the rows below, we can see similar data for all the other expiry months. And please note that all the delivery months are trading at related, but nonetheless slightly different prices. All these rows below, November futures, December futures, you can see that these prices are all, in the $84, $85 range, but they're slightly different, but related. Now, we can talk about why we have differences in different expiry months, different prices in different expiry months in later sessions. But for the moment, I would just respectfully ask you to note that is the case. Okay. So, and here, this is a graphic representation of all those different expiry month prices we saw in the last slide. Each one of the dots on these curves, you can see here, represents a futures expiry month. So this horizontal axis represents all the different expiry months that are available for trading a crude oil. It goes out quite a long way, and the horizontal axis is price. So each one of these dots in the curve you can see here represents the futures expiry month and the price at which they're trading. So we can see, now we're looking at a chart, we're looking at a graph, we can see that the nearer to expiry months are trading at higher prices than the further to expiry months. Now, Oh, by the way, I know there's 3 curves here because we're looking back in time at how the curve looked last week and the week before that. It's just one curve in practical purposes, okay? So forgive me for that. Now, the shape of this curve can change. At the moment, it's quite steep, isn't it? It might get steeper, it might get flatter. And as traders, we can seek to exploit a change in that shape. We call it trading the curve. And trading the curve is something that professional traders do globally across all asset classes, from interest rates to stock futures to commodity futures. It's very rare these days that any professional trader just goes long or short of one asset. That's seen as a very blunt, unsophisticated way of going about trading. Everything is about relationships. So with these curves, we can look to exploit a change in that shape. And we can do that by taking a long position in one expiry month and a short position in another expiry month. But why do we want to be this complex about our trading? Well, the answer to that is risk management. Through executing a long short position in a future contract, we can take away any exposure to a violent move in the overall price of the asset and simply look to exploit a small shift on that curve. We're trying to be scientific and risk averse. Okay. When we buy one expiry month and we sell another expiry month simultaneously, we call that a calendar spread, sometimes also known as a time spread. So on this screen, we can see the prices for the Brent crude futures calendar spreads at the time I wrote this presentation. Now, there are a lot of numbers on this screen, and I don't want to cause any confusion once more. So let's have a look at just the top row as an example. Can you see there is a 55 ticks, a 55 cents bid price and a 56 ticks offer price? Okay, that represents the difference between the October expiry month and the November expiry month. The difference between the 2 months. We call that spread October, November, the OCNOV spread. We can buy or sell that difference and look to make a profit on small incremental changes in the pricing curve. So this screenshot was taken on the same day as the screenshot of the outright futures prices we just saw. You can have a look at the high and low columns for the October-November calendar spread. Can you see it here? The high price for that spread on this day was 65 ticks, 65 cents, and the low price was 50 cents. Okay, a much lower range than the range of the single October future, which was $1.12. 112 ticks, and traders like that lower volatility of the calendar spreads because it means they can trade this important asset in a reasonably low volatility environment. It can be very scary just to jump in and trade something that's very volatile. So if you can reduce that volatility, that's really helpful. Okay, now you might be saying, okay, this is all very well and very interesting, but I want to trade the simple futures price. I've got no idea about the price behavior of calendar spreads. I do have a firm view on the direction of the futures price, but how does that translate into calendar spreads? That would be a very pertinent question. Okay, well, traders internationally have observed over time that there is normally a directional price relationship between the price of an asset itself and the value of the corresponding calendar spreads. Now, there's no guarantee of what I'm about to say, a very important caveat. But generally speaking, as the price of crude oil, for example, goes up, the crude oil calendar spreads increase in value. That's to say the nearer dated months go up more than the further dated months. We call that a curve steepener. That curve steepens as the price goes up. And as the price of crude oil goes down, the spreads tend to decrease in value. That's to say the nearer dated months go down more than the further dated months, and the curve flattens, possibly goes around the other way. By the way, this doesn't happen very quickly. It's all very kind of slow and calm, the changes in the curve. We can see an example of the relationship on this slide. Once more, I do understand that this chart may be very confusing, so let me explain. This bolder line that you might be able to see looks a bit messy, but the bolder price action represents the outright, the single December futures price in crude oil over the last couple of years. The price axis for that is on the right. Can you see it here? So a couple of years ago, crude oil was trading down at $64 a barrel. This December contract has been nearly $100 a barrel. And at the time I took the screenshot, it was around $84 a barrel. Okay. Now, you know, quite a lot of range, quite a lot of volatility. Now, the thinner price data that you can see in that thinner black line, superimposed over the top of that December futures price, is the price history of the December-June crude oil futures calendar spread. The price axis for that is on the left. Can you see over here? So let me see. The range in that has been, we started around $1.40, been down to 40 cents. You see up here, been up to about $6, 600 ticks if you like. A much narrower range than the actual futures price of crude oil. So these are different things with different price ranges. That price range of the calendar spread is different to the actual price of crude oil. But what I want you to note here is the directional relationship. It's very confusing looking at this chart, isn't it? It's hard to tell the two apart. There's a very positive correlation. So we can, in fact, use a futures calendar spread as a substitute for trading the outright crude oil price. But the calendar spreads are less volatile. The range is smaller. Okay, so you get to make less money, but you take on less risk, and that's very important. Risk is always at the forefront of our minds. We can trade in a lower risk environment. Now, all these principles I'm discussing here apply to other assets too, not just crude oil. I'm merely using it as an example. I'm using my experience to hopefully be of benefit to you. You can apply this logic in Saudi Arabia too. It applies to products in the kingdom. Okay, coming to the end of my first session, we're going to take a 5-minute break in a few moments. I just wanted to very, very briefly discuss one other subject. I do have very little time today, but I just wanted to touch on the subject of technical analysis. So professional futures traders will examine charts of price history and try to find, for example, floors and ceilings formed by the price action, and then use those levels as entry and exit points in the market. We can see here there's a kind of ceiling in the crude oil price. This is the December contract of around $87. It reached that high once, my goodness, last year, nearly reached that high again and failed there and slid away. And we could see there's a kind of floor here. By the way, I prepared this chart very hastily. It's not a perfect example. Just trying to give you an example of how we can look at historical price action in graphic form to inform ourselves, give us some idea about price action. It's not only floors and ceilings we look at. Technical analysis is a very big subject. Again, we teach on this and we can provide you with information about courses that we run on that. If you'd like to know about that, of course, that's, you know, it's entirely up to you. We can look at things like retracements and trend lines and double tops and double bottoms and price target information and breakout patterns. It really is a vast subject. Even if you don't want to learn from us, do further reading on this. You know, just go on the internet and look for further reading on this. It's a fascinating subject, and it helps you be more informed about your trading. Patterns do repeat themselves because when you're looking at traded prices, of course, what we're looking at is human behavior, and human behavior doesn't change much over the weeks, years, decades, and millennia. You'd be quite surprised. When you're looking at markets in graphic form, you're almost studying human psychology, but I'm probably getting a little bit out of my remit there. Now, technical analysis is a very wide subject. It's a massive subject, but one thing I'd really like to say to you, even if you never employ that skill in any large sense, and even if you don't require any further training on it, or you don't want to do any further reading on it, I would really implore you to always look at price action in graphic form. It's so much easier to look at a picture than just loads of numbers and data. Always look at the price action of an asset, the Saudi stock index, crude oil futures, Aramco single stock futures, you know, a Saudi government bond, whatever you happen to be looking at, look at the price action in graphic form because it will keep you better informed. It's easier to make sense of it. And you can start to draw on lines of, as I've done here, just by way of example, and really start to help you with your entry and exit points. Okay, enough of that subject. What I'm going to do now here is we're going to take a quick 5-minute break, if that's okay. Allow everyone to grab themselves some refreshments, use the bathroom, and then I'm going to be back to you to talk for about another 45 minutes on the subject of the second derivative we want to talk about, options. But right now, I'm going to pause if that's okay with Ibrahim and Ahmed and our other leaders today, take a 5-minute break and I will return to you in 5 minutes. Is that okay? Okay. Let me see, what time is it here in the UK? 5 minutes to 9. I'll be returning at 9 o'clock. Is that okay, Ibrahim, if you can hear me?
Yes, perfect.
Perfect. I shall be back in 5 minutes. Thank you all.
Thank you.
get some refreshments. Let's move along quickly onto our next subject, because limited time today and quite a lot of information to get through. So subject of options. This is a very big subject and we can only really touch upon it today, but it's very dear to my heart because I was an options trader in the City of London for many years, and options are just incredibly useful tools, and it's the development of them being launched in the kingdom is extremely exciting. So it's important that we think about options in an intelligent and flexible way. They're incredibly useful and adaptable financial instruments, although they do take a lot of understanding. As we get further along in our understanding of options in later sessions, potentially, we can begin to understand that we can trade volatility as an asset in its own right. Now, that's quite high science, and it's a little bit ahead of us right now, but it's something I just want to put in your minds. There are more ways to make money out of markets than just going long or short of them. We can make money out of the volatility in the markets. Now, admittedly, once more, if we get it right. But my big point is that at the very least, we shouldn't be a victim of volatility. We should be able to protect ourselves from it and possibly even profit from it. But let's step back from that advanced idea of trading volatility right now as an asset in its own right and go through the basic option definition on the screen. And even this is quite a lot of information to take in. So an option contract represents the rights, but not the obligation to buy or sell, depending on what type of option we buy, an asset at a specific price on or before a future date. Now, just like futures, options are contracts, they're transferable, they're freely traded, bought or sold. I'm very aware, by the way, this is quite an unwieldy definition, so don't worry. We're going to go through examples which will make things a lot clearer. Straight away, what I want to say to you, though, is the key element of an option contract definition is this: the right, but not the obligation. When we buy options, we don't have obligations, which is an incredibly useful thing. Okay, let's go through this slide. We have two types of option. We call them classes, two classes of options. We have call options, which we abbreviate to calls. A call option conveys the right to buy an asset. When we buy a call option, we gain the right to buy an asset. So crude oil calls convey the right, but not the obligation. Note the italics because it's so important to buy crude oil futures. What about put options? When we buy a put option, abbreviated to puts, they convey the right to sell an underlying asset. For example, single stock puts, as listed on Tadawul, convey the right, but not the obligation to sell the underlying stock. Okay. Again, once more, really important point is this, but not the obligation. So options, when we can buy them, convey the rights. To summarize here, options convey the right, but not the obligation to buy in the case of a call option, or sell in the case of a put option, an asset, which we call the underlying, that's the globally used term, the underlying, at a specific strike price on or before a given future date, which we call expiration. I've taught on this subject for years. I was an options trader for years. When I read through that definition there, my head spins. I think, what does that mean? Even now. So don't worry, I'm going to go through an example. But anyway, continuing just for the moment on this slide, because options convey the right, but not obligations, they command a price, a premium. We call the price of an option a premium. It's a globally accepted term. Now, just like futures, options traded on exchanges have standardized quantities and dates. Now, let's get on to our examples now. Hopefully things will become a little bit clearer here. This is the classic way of looking at a set of option premiums. We call it an options matrix. There are some real option prices here from the 31st of August this year, based on US stock market index futures. We're looking at the S&P 500 index futures and options here. It's a really important point I'm about to make. Everything I discuss here will apply to the MT30 index options that are soon to be launched by Tadawul. And everything I discuss here will also apply to single stock options on Tadawul. I'm just using the world's biggest stock market index as an example, okay? And the world's biggest stock market index is currently the S&P 500. Now, got some information in the title slide up here. The data from the 31st of August, sorry, it's expressed in English dating, the 31st of August 2023. These are December expiry, S&P 500, S&P 500 being the US stock market index, index options. I'll come back to that in a moment. 106 DTE, I will return to that in a moment. Now, at the time of writing, the December expiry S&P 500 future was trading at 4,574 index points. Okay. So in the middle, you can see the option strike prices. Now, by the way, they aren't all of them. That's just a selection. There are many, many more than those. I've just chosen a selection. And anyway, on the left, we have the call premiums as they were at the time. I'm not showing the bids and offers here. I'm just showing one number, the fair value, the middle value, if you like. In actual fact, it was the settlement prices from this day. So on the left, there are the call premiums for these strike prices. And on the right, we have the put premiums. Now, we're going to look at an example. It's always best to go through an example, isn't it, to understand things. So we're going to look at the December 47.50 call option priced at 47 ticks. That's the premium. That's the way we express, that's the way we describe an option, by the way. We say the product name first, followed by the expiry month, followed by the strike price, followed by the option class. So product description, we are looking at the S&P 500, December, we say the expiry next, strike price next, 47.50 call option. Okay, and it's priced at 47. That was the market price at the time, decided by market forces. So if you were to buy that option, if you decided to buy the 47.50 call, you pay that premium away. You have to pay that 47 ticks of premium. If you sell that option, you receive that 47 ticks of premium. Now, one final thing, in the brackets at the top, you can see it says 106 DTE. DTE means days to expiry. So these options, at the time of writing, this particular set of December options had a lifespan of 106 days. That's what we're looking at here. So let's go through that example option I was just discussing, the December 47.50 call. We would never say the 4,750 call. It's quite complicated. You become garbled. We'd say the 47.50 call. So with the DEC S&P future trading at 45.74, the DEC 47.50 call was priced at 47. Can you see that that strike price at which we could buy futures is above the current price? It's what we call an out of the money option that I'm choosing as an example here. By the way, each S&P 500 tick is worth $10. So if you buy one lot, one contract of the December 47.50 calls, it would cost you $470. Now, one lot of the December 47.50 calls conveys upon the buyer the right, but not the obligation, to buy one lot of the DEC S&P 500 futures, the underlying, at 47.50, the option strike price, at any time up to December option expiry, which is in 106 days' time. So we've got 106 days for this to potentially work. So we can freely trade, we can buy or sell this call option. Now, why might we buy? I beg your pardon. I just touched the wheel of my mouse there. I didn't mean to scroll down. Did I scroll down? There we are. So why might we buy that call option? Well, if we were bullish on the stock market, we could simply buy futures, right? But we might make a lot and we might lose a lot. If we buy the 4,750, the 47.50 call option, though, as an alternative to buying futures, we have unlimited profit potential should the index rise over our strike price of 47.50. There's no limit to how high the US stock market can go. So we have unlimited profit potential should the index rise, but we have a known and limited loss, 47 ticks. We cannot lose more than the 47 ticks we paid for that option. And of course, we would lose that 47 ticks if the market doesn't go up over the next 106 days. If that index, the US, if the S&P 500 future currently priced at 4,574 doesn't go above 4,750, well, we will lose that 47 ticks premium. Now, again, because of the nature of this being a kind of a beginner presentation, I can't touch upon all the dimensions of options trading. It's not that binary. A lot may happen over the next 106 days. If the stock market starts to go up between now and then, even if it doesn't break through that strike price, everything else being equal, and again, that's an important condition, the price of this option might well go up. Okay, it's got a positive correlation with the underlying futures price. The futures price might go up immediately. It might go up in the next day or two and go crashing through our strike price. It might not take 106 days to do it. And if it does that, our option becomes very profitable immediately. And there's all kinds of choices that are very beneficial to us that we can make. And again, we'll have to cover those in future sessions. But anyway, the important point to know is that over the next 106 days, through buying a call option, because we're not obliged to exercise an option, we've got a limited and known risk of 47 ticks. If the S&P index rose to, let's say, over 5,000, if the futures price rose to 5,000 over the next 106 days, in very simple terms, we could exercise our right to buy an S&P 500 future at the strike price of 4,750, and then sell the future that we bought at 4,750 at the index price of 5,000 if it went up there. Now, clearly, we're only ever going to exercise an option if it is profitable to do so. It's up to us as the owner of the option. We're never going to exercise an option for loss. Okay, we can only ever lose that 47 ticks if we turn out to be wrong. So that's why we might buy that call option. As a speculator, for example, we might buy a call option if we are bullish on the stock market. We believe that option price represents good value. That would have to be another qualification. And we're conservative in our trading approach. We want to have a known and quantifiable loss, in this case 47 ticks, and unlimited profit potential. That's the kind of difference with buying options as opposed to futures. Okay. So now let's look at another example. We're going to look at the December 4,350 put option priced at 65 ticks, the 43.50 put. Right. So the December S&P 500 future price, once more, is the same. Our reference price for that on that matrix of prices is 4,574. The deck 43.50 put was priced, the market price at the time was 65. That's the option premium. One lot of the December 43.50 puts conveys the right, but not the obligation, to sell, go short of one lot of the deck S&P 500 futures, the underlying, at the option strike price of 43.50. And we can do that at any time up to December option expiry, which at the time of writing was in 106 days' time. We can freely trade, buy or sell this put option. Let's go through the same thought process. Why? What would be the reason for buying this put option? Well, if we were bearish in the stock market, we could simply go short of futures. We know that. A great advantage of derivatives. We could make a lot, we might lose a lot. You know, we have to say that, it's really important. But if we buy the 43.50 put as an alternative to selling futures, we have unlimited potential for profit if the underlying market goes down, should the index fall over the next 106 days, but we have a known and limited loss, 47 ticks, in the event that the stock market doesn't go down over the next 106 days. If the S&P index futures fell to, let's say, 4,000, currently, bear in mind, the index is 4,574. Let's just say an imaginary scenario, that index fell to 4,000 in the near future, at any time over the next 106 days. We could then exercise our option. We could exercise our right to sell an S&P 500 future at the strike price of 4,350 and then buy back that resulting future in the open market at the new price I'm imagining of 4,000. But we can only ever lose the 65 ticks of premium if we turn out to be wrong. So again, really important point here. When we buy an option, we have a known maximum loss, which is the price of the option, the premium, and we have unlimited potential profit. Something that is very important to say here, because this can sound a bit too good to be true, right? And it's very important I highlight the downsides of options too. When we buy options, we can and we will lose money through the passing of time. So if just nothing happens, when we buy an option, they do erode. That premium will slowly erode. That option will become worth less and less if nothing happens. It's important to say that. It's also very important to say that when we buy an option, I want to repeat what I said, we have a known maximum potential loss, the premium we paid, and unlimited potential profit. But as I just said, that can sound almost too good to be true. Time is working against us when we buy options. We speak of time decay. So timing is a skill that we need to develop, getting our timing right, but technical analysis and experience can help us with that. And as I say, we can provide further training on that. Right. Insurance and options, an intuitive comparison. That's the title to this slide. We have some shared language, some shared linguistic roots between the world of options and the world of insurance. So as you all know, we describe the price of insurance as its premium. That's the global term for an insurance policy. When we buy insurance in our day-to-day lives, on our car, on our house, on our lives, we call it insurance premium, just as the price of an option is also a premium. If we were to go back in time to when I first traded options in the early 1990s, you would hear me describe an option seller as someone who writes an option, just as an insurance underwriter is someone or a company that sells insurance. They write insurance. So options, we could say, are simply price insurance contracts. And the shared language between the options and insurance businesses really underlines that fact. If you buy an option contract or an insurance policy, you pay a premium. And then it's you who decides whether to exercise that option. It's you who decides whether to make a claim on an insurance policy. Can you see the similarities there? It's quite fascinating. The sellers of options or insurance policies are reactive. They receive the premium. That's how they make money. But then they can only wait and see what the buyer does. They are reactive by nature. We will discover in potential later training sessions that the pricing inputs to options and insurance policies are pretty much the same. It's quite a handy thing to think of options contracts as insurance policies when you first visit them, because it helps with your understanding of them. It helps accelerate your learning. Okay. So option contracts are transferable. They can be bought and sold freely. You can buy an option and you can sell an option moments later. You can sell it tomorrow or next week. You can sell an option. By the way, it's perfectly possible to sell options. We'll come to that later on. And you can buy it back in the next moment or the next day or the next week. But we could decide to run an option all the way to expiry. So what happens then? Well, there are two possibilities. The expiring option either has value, exercisable value, or it does not. You've lost the premium. An option that has value on expiry is automatically exercised by the exchange or the clearinghouse. Options without value on expiry are abandoned. They simply automatically expire worthless. So let's bear in mind that options are contracts. Derivatives contracts only exist when there is a buyer and a seller. It's not like a stock, is it? A stock, on Aramco just exists, it's there. But a derivative contract only exists when it's open between a buyer and a seller. We need a long and a short for a derivative contract to exist. For every long of a particular option, there must be an equal and opposite short of that option for it to exist. One position is a mirror image of the other. So as I've said, a buyer of an option can exercise an option, exercise the right to buy in the case of a call, or exercise their right to sell in the case of a put option. And you'll do that at the option strike price. So when an option buyer exercises an option, as I say, this will happen automatically upon expiry if the option has value. The seller of that option is assigned. That's the language we use. They become assigned. The option seller is compelled to buy or sell the underlying asset at the option strike price. So the option owners, the option owner's exercise is equal and opposite to the option seller's assignment. They're a mirror image. Now, once more, that's a lot of confusing language. So I'm going to go through an example on the next slide. The strike prices I'm using here, if you were to refer back, aren't mentioned on that table, that matrix of option prices that I've been using. As I said, that's just a selection of strike prices. There are many more available for trading. So let's say that some time ago, a trader, an investor, bought one lot of the December 4100 calls, not showing on that table that we looked at earlier. They did this some time ago. The owner of that option may decide to exercise their right to buy one lot of the December S&P 500 futures at the option strike price 4,100. Clearly, the option buyer is only going to do that if that results in profit. Now, a trader holding a short position in that option will be assigned. They will be compelled to sell one lot of the DEC S&P 500 futures at the index price of 4,100, regardless of the current price of DEC S&P 500 futures. As I've said, the owner of an option is only going to exercise their option if a profit results. That's the great thing about them. Otherwise, the option will be allowed to expire worthless. And all this will happen automatically at the moment of expiry. So, exercise assignment examples. Let's go through another example. Let's talk about a put. Let's talk about the December. By the way, we always abbreviate December to DEC. You'll hear traders talk about DEC rather than December. You'll hear traders talk about NOV rather than November. Can be confusing initially. So let's say that some time ago, an investor, a trader, bought one lot, one contract of the December S&P 500 4,800 puts. If they so wish, they can exercise, because it's a put option, their right to sell, to go short of one lot of DEC S&P 500 futures at 4,800. So a trader will have a short position in that contract, as I explained earlier on. A trader holding a short position in that option will be assigned. That trader will be compelled to buy one lot of DEC S&P 500 futures at 4,800, regardless of the current price of December S&P 500 futures. And once more, the owner of the option is only going to exercise if it's profitable. Otherwise, they will just abandon the option. It will expire worthless. Okay, let's just tell you a little bit about the history of options. It's quite fascinating, actually, and it helps to put things in context. Options have actually been around for centuries, some say for thousands of years, but they were widely used in using the country's name Holland there. I should really use the name the Netherlands. So the Netherlands, small country, I've got very good fond associations with this country. The Netherlands were trading options in the 1630s. There was a tulip bulb mania. The tulip is a flower, very common in the Netherlands. And believe it or not, in the 1600s, there was a mania for buying tulip bulbs. It was an asset bubble. I guess you can compare it to sort of modern fad for cryptocurrencies and so on. Anyway, they weren't just buying and selling tulip bulbs, they were buying and selling them for future delivery. They were trading options on tulip bulbs. Absolutely amazing, right? I'm also told that options were used in the American Civil War over 250, 300 years ago. The North American states and the South American states who were fighting each other used currency options on the French franc to hedge themselves against the possibility of losing the war. The French franc was, at the time, the international currency. Okay, CBOT, what does that stand for? The Chicago Board of Trade. That was established in 1848, the first kind of derivatives exchange. They launched futures contracts in 1865. But we're working on a pretty ancient industry here. Now, the CBOE, the Chicago Board Options Exchange, do quite a lot of work with them in actual fact. That was established in 1973. So options trading, although it's been around for hundreds of years, really got going in the 1970s. But why? Well, technology, computers, communication, the Black-Scholes formula. Okay, let's talk about Black-Scholes. You can see these pictures of these gentlemen here, Black-Scholes and Merton, very clever gentlemen who came up with a formal mathematical formula for pricing up options. By the way, you don't need to use the Black-Scholes formula. You don't need to know the Black-Scholes formula to trade options. That's just a bit of high science that lies behind all of this. But those guys won the Nobel Prize for coming up with a formula for pricing options in the 1970s. So new technology, the Black-Scholes formula, market deregulation led to an explosion of options use from the late 1970s onwards. So, as with futures, there are two main reasons for using them. Protection, price protection, which we call hedging, and indeed for speculative reasons. Okay, let's talk about hedging first. And you can see I brought up the matrix of option prices once more, the S&P 500 matrix. In this example, let's say that you own a portfolio of US stocks in your investment account. But again, in an imaginary scenario, let's say you are fearful of the stock market falling. We discussed earlier that it's possible to take a short position in index futures to price hedge an equity portfolio. But the challenge of hedging with futures is you are then potentially locked in. If you go short of index futures to hedge a portfolio of stocks, and then the stock market continues to rise, any gain on your equity portfolio will be cancelled out by your short position in index futures. Sure, you're hedged, sure, you're protected, but potentially you're losing opportunity. As I said earlier on, you can quickly exit that futures position if you want, but nonetheless, I'm sure you get my point. It's a disadvantage, if you like, of futures. Lots of advantages with futures, but we also need to talk about the disadvantages. So let's think about using options as an alternative hedging choice to protect a portfolio of US equities. So let's talk about that. So to protect our portfolio, assuming we had one, we could buy, for example, some 4,350 puts. We've got a huge range of options we can choose. Just an arbitrary choice here. Going to choose a strike price below the current index price, 43.50 puts. So they have to pay that premium for 65 ticks for the 43.50 put. Let's say that's the level at which I really want to be able to exit the market. That's the strike. That's the reason for choosing that strike price. You can see all these options at different prices. At 43.50 put, strike price is priced at 65 ticks. That was the market value at the time. So if I bought those options, those 43.50 puts, if the futures market, essentially the US stock market, were to then collapse, let's say to 3,500, we saw a stock market crash at any time over the next 106 days, we could then exercise our put option. That's to say we could exercise our right to sell S&P futures at the strike price of 43.50, which would offset the losses we will make on our exit portfolio. We could press our escape hatch, okay? Put it that way. And by the way, in the real world of trading, I'm just doing an example here. I've said you could exercise your put option. Probably the most efficient way of taking profit on those options would be to simply sell out the options. The option price would have increased enormously from 65 to hundreds and hundreds of ticks. We could actually just sell out the put option profit and use that profit to offset the losses on our portfolio. But I don't want to get too complex here. Let's just stick to saying we would exercise our options for the moment. We would exercise our rights, if we own those put options, to sell December futures at the strike price of 43.50. Now, the great thing about buying options to hedge our portfolio is that if the stock market, if we were wrong in our view, and the stock market rose aggressively over the next 106 days, we could still benefit from that rally because we're not obliged to exercise the put options. All that we can lose is the 65 ticks we paid for them. Now, that is money. I'm not saying it's not a considerable amount of money. It is, but nonetheless, let's not detract here. That's all we can lose. If the stock market index rose to, say, 5,000 in the next few months, we quite often get big rallies approaching Christmas, not always, but we do, we would see our portfolio gain in value. And all we could lose is that 65 ticks, the option premium, our insurance policy, right? So through hedging, through buying put options, our equity portfolio, we maintain potential upside benefits. But it's important to say we do have to pay the option premium. Now, again, there are all kinds of option strategies we can employ which can mitigate the cost of option premiums. But again, that would have to wait. Explaining that would need to wait for another day. Okay, so let's ask this question. We've been asked this in the past. Can you sell options? Can you sell call options to hedge a price exposure? The answer to that is no. Just like insurance, we need to buy options to gain protection. You cannot sell options to gain protection. Now, you can sell options against an underlying position, and we call that yield enhancement. Yield enhancement is a very popular strategy in equity markets. It's also known as covered calls. So what does that mean? It means if we have a long position of stocks and Tadawul, and we, by way of example, and we intend to hold those stocks for a long time, for years, let's say, we could sell call options with a strike price above the current stock price and receive those option premiums. This would enhance the dividend income we receive in the stocks we are holding. Now, if the stock price rose a lot, we might be assigned on those call options we sell, but that's okay. At least we have the stock to sell. It will be at a higher price than the entry price. But it's important to say that if the stock market did go up, we would then be forced to sell out part of our portfolio. But yield enhancement, selling covered calls, is quite a popular strategy for investors when they are holding a long stock portfolio. They want to receive some option premium. It enhances their yield, it enhances their income, and people are willing to accept if the stock market goes up, they then might have to sell out their stock portfolio, but that's okay. That's actually quite a good thing. But can you see that we're not selling options in isolation there? There's a really big health warning I want to make to everyone here. There's a saying we have in the markets saying selling options naked. It might sound a bit odd when I say that, but it's a term we really use. Selling options naked means selling them in isolation. You haven't got any equity portfolio, you haven't got any other long option positions against it. You're just selling them as a bet. That's very inadvisable. When you sell an option, you have a known profit. That's the premium you receive, but you take on unlimited risk. And that's just not something you should do. It's not against the law. You don't get in trouble for doing it anywhere that I know in the world, but it's simply not advisable. It can start to cause you a lot of harm. We can sell options, and of course we must be able to sell options, otherwise we're just one-dimensional traders, but there are intelligent ways of doing it. Again, that's something that we'd have to come to at a later date. So the two main reasons for trading options are the same as futures. We talk about protection, price hedging, and speculation. Let's now talk about using options to speculate. We spoke about hedging a moment ago. Now, options, like all derivatives, were invented to allow investors to hedge. That's why all derivative contracts were invented. At some exchanges, there are thousands and thousands of derivative contracts, and they all had their origins. They were all launched to allow people to hedge. If truth be told, in practice, most option use these days is speculative. It's not a bad thing, it's just a fact. Clearly, options can be bought or sold for speculative purposes. I've just been over the dangers of selling options. But speculators buy and sell options for very different reasons and with radically different perspectives on risk. And I've just sort of alluded to those. So once more, we're back to our matrix, our table of options here. So why do speculators like to buy options? It's all about risk and reward. When we buy options, the maximum loss is known. So this means that the clearinghouse, Macasa, the margin that they ask for on long options is less than that for similar futures positions. This means for a set amount of capital, we can buy more options than we can buy futures. There is also the element of risk management. As I said a short while ago, futures traders need to use stop loss orders. By the way, I'm not decrying futures, they both have their place. But futures traders, when they take a speculative position, need to place stop loss orders to limit losses if they're wrong on their view of the market. Stop loss orders are not required when we buy options with long option positions because the maximum loss is known. It's limited to the premium we paid. Now, you might not want to lose all the premium you paid, but there is a maximum amount you can lose, and it is that premium. So when we buy options, we don't face potentially unlimited losses, which is a really important thing. Long option positions, that's to say buying call options or buying put options, being long of options. Having a long position options, we can also hold them for longer periods, more than just intraday, more than just during the day or short periods of time. We can sleep at night with a long options position because of their limited loss nature. If as a speculator, we are feeling bearish on the US stock market, we could buy, let's go for the 43.50 puts again here. If we were just as a speculator, no underlying exposure, we're just speculating, we could buy the 43.50 puts, for example, and then we would benefit from the stock market falling at any time over the next 106 days. If there's a stock market crash, we make money, a good thing, right? Now, I'm really generalizing here, massively generalizing, but I'm just trying to give a bit of insight. I suppose day traders, shorter term traders tend to use futures, and longer term people with a 1 week, a 2 week, a 4 week perspective, they tend to use options. You can be a bit more strategic, although you can do either. Now, everything I've just said there is summarized on this next slide. I won't repeat, well, I'll just basically re-summarize, but why do speculators buy options? Risk reward. When buying options, you've got a known maximum loss. So margin on long options positions is generally lower than that for similar futures positions. Don't think in those terms when you sell options. It's a different thing. Risk. Futures traders, equities traders have to place stop loss orders to limit losses if they're wrong. It's not required with long option positions because we've got a maximum known loss. I'm not saying that you don't lose money buying options. You do. I spent a lot of time in my career when I was an options trader buying options and losing money on them. You know, it's a fact of life. I'm not saying this is easy. It isn't. But nonetheless, that is the advantage of a long option position. In very noisy markets, quite volatile, sometimes it can be easier holding a long options position rather than a futures position. We can hold them longer. No rules and regulations on this, but I suppose in general terms, you can be a bit more strategic. Okay. Summarized. Okay. We're getting towards the end of the presentation now. I'm sure you'll be pleased to know. We can also use options to speculate with precision. We can be really scientific with options, really strategic. Options are really suited to strategic minds, to disciplined minds, to those who like to plan. Now, Fisher Black, one of the gentlemen who wrote the Black-Scholes formula, said, with derivatives, you can have almost any payoff pattern you want. If you can draw it on paper or describe it in words, someone can design a derivative that gives you that payoff. What he's really referring to here are options. Like I say, we don't have time for this today, but you'd be amazed at the amount of derivatives spreads we can construct. We hinted at spread trading long short positions when we spoke about futures, and we showed you one of the choices there. With options, the choice of spreads is almost infinite. It's amazing. It's fascinating. Strategic buying one option to sell another option. We've got all kinds of weird and wonderful names in the world of options. Call spreads, put spreads, straddles, strangles, butterflies, condors, strange words, right? They all describe combinations of options contracts that could be used to fine-tune a derivatives position to optimally suit your attitude to the market, your risk, your attitude to risk, your timing, profit targets, loss targets, everything. It doesn't mean to say you're guaranteed to make money, but we can come up with an optimum strategy. We can make option positions really precise rather than just blunt. But again, you do further reading on this. Look up option strategies on the internet. Please do that. Educate yourselves. I'd really encourage that. And there's lots of good resources out there. Or please contact the Saudi Financial Academy or contact us for further training. Anyway, so that's directly from Fisher's mouth. We are coming to the end now. Now, I spoke about the dangers of selling options, and it's very important that I say that. It's not illegal to sell options, but as I said, it's really important to state that when we sell an option in isolation, we use the term naked. If you sell naked options, you have a known potential profit, the premium you receive, unlimited potential loss. An awful lot of the time you might get away with it, but in a stock market crash or a market panic, you can find yourself facing very high losses. So it really needs to be stated. But for every option buyer, there has to be a seller. If you're buying options, someone has to be selling them, right? So who sells options and why? Okay. In practice, many market participants like to sell options. There are loads of very large financial institutions, experienced traders who will sell options. Yeah, they deem them to be too expensive. That's why we sell something, right? See, if that option looks expensive, I'm going to sell it. And that's extremely rational. They might believe that the underlying asset is not going to move, that everything's going to stand still. And time decay will make all those options go to zero. You sell options. It's logical. It makes sense. As I say, your options erode over time. So Zishi, the training company, we believe there are good and bad ways of selling options. We don't say don't sell options. There are good and bad ways of doing it. The bad way, we would argue, it's subjective, is selling options naked. You need to use one of those option strategies. Call spreads. You don't sell calls, you sell call spreads. You don't sell puts, you sell put spreads. And we'd have to enlarge upon those strategies because it's almost infinite choice in later sessions. But I really would like to say to you that selling options naked is not a very good idea. It doesn't actually make intellectual sense really, because there are good alternatives to doing that. but it's not illegal. We can do that. And of course, you can sell options as yield enhancement. I went through that earlier on. If you own some stocks and you're hanging on to those stocks and you intend to hold them for a long while, sure, selling call options against those with higher strike prices than the current price to receive those option premiums, to receive yields, is logical. Please be aware you're not hedged. Your stock portfolio then is not protected should there be a stock market crash. All you're doing is enhancing your yield. Really important to say, it's not illegal. It's not against the rules to sell options, but the risk health warning is really important. And it's really important to say there are strategic ways of doing that we can talk about along with the Saudi Financial Academy on another occasion. And clearly people are selling options, otherwise you wouldn't be able to buy them. Options have to have, markets have to have two dimensions to them. We can't only have buyers, we must have sellers. But the dynamics of options are different to normal assets, different to normal stocks and shares, and different to normal vanilla futures. Okay, so hopefully that's reasonably clear. Although this is a big subject. This is a big subject. We've only been able to touch upon the subject of options in the time available to us. It is a broad subject, complex, but also very useful. And I think it's extremely exciting, the developments in your part of the world. These product launches are opening up all kinds of opportunities for institutional and private investors. Now, on that note, I'm going to bring this session to a close, and I'm going to ask Ibrahim, our colleague from the Saudi Financial Academy, if there are any questions. So just before I do wrap up, I'd really like to thank everyone for your kind attention today. I hope this has been of some use to you. You'll be the judge of that, of course. It's been a pleasure delivering this. I do hope to speak to you again. I hope to visit Saudi Arabia. It will be a great honor. But I'm going to wrap up now and pass over to Ibrahim just to see if we have any questions. So Ibrahim, over to you. Ibrahim, you're on mute. I don't know if that's
Thank you, Mr. Simon, for this.
No worries.
And we're so happy to have this webinar with you. And of course, we would like to see you in Saudi Arabia to see it. And of course, we have some questions we would like to ask you. The first question is, what is the greatest challenge for the investors who is new to the future and the options markets?
Okay, I think the greatest challenge for new entrants to futures and options is this. It's really exciting. There is so much choice, you know. We're only now talking about product launches on Tadawul, so there's going to be a limited amount of products, which in a way is a good thing. If you start looking at some of the Western exchanges, your head explodes. There's so much choice. I think being in this really exciting early stages of product development on Tadawul with the single stock options, the index futures and index options, you know, we've kind of got a certain amount of choice. But even then, with all the strike prices that are available in options, there's quite a lot of choice. So the challenge is being disciplined in your approach. So what I really want to emphasize here is practice good risk management, practice patience, and practice discipline. I think the biggest challenge is, to begin with, there's almost too much choice. Yeah. But yeah, you got to get around that.
Yeah, that's great. Okay. There's another question, which is, which of the two derivatives, futures and options, is the most useful to traders and investors?
Okay, that's a very good question too. So the answer to that is neither. We've got to, if we want to get really sort of professional in our approach to this, we've got to use all the weapons available to us. But different derivatives and different equities are appropriate for different times and different situations. Sometimes futures are the right choice. If you really have a very, very strong view in the market and you want to get immediate exposure, futures are probably the answer. If you want to be a bit more strategic in your approach and you're a bit more concerned with timing and risk, then options may be the right choice. So you've got to slowly develop a decision tree. What's my view in the market? What's my attitude to risk? What's my view and timing? How immediate do I want to be? What kind of exposure do I be? So quite often I get asked that question, which is better? My answer is this. You're not just a futures trader. You're not just an options trader. You're not just an equity trader. You're all of them. It's learning to bring all these things together and choosing your weapon of choice at the right time.
Brilliant. Great. Okay, how do you make a judgment on the value of the options premium, about whether is it fairly priced?
Yeah. Okay. Again, a question we get asked quite a lot. How do we make a choice on options premiums? Well, we showed some of those option premiums on a screen, didn't we? So people might say, well, how do I know if they represent good value? Sure, I can buy that put option. Sure, I could buy that call option. But how do I know if that's the right price? Well, the honest answer to that is you don't know, just like we don't know whether the price of the index is right. Only time will tell. But to dig a little bit deeper, when we start getting into the higher science behind options, and we can provide further information on this, we can see that each option price implies what we call a volatility, implies a certain amount of uncertainty in the market. We can actually look at a number that reflects that. Some people give it the name the fear index, and we can do that on any option from Tadawul to the US to the UK to Europe. We couldn't go into that today. We can start to look at the volatility, the fear, the amount of volatility implied by the option price itself. And this is publicly available information. You don't need to be working at a hedge fund to get this information. You just need to know the sources to go and look at. And that can start to help you make a value judgment on the option price itself. I want to say, though, you don't even need to be that scientific. You can just look at the option price, the option premium, and you just say to yourself, you use your experience, you use your gut instinct. Does it look like good value? Just like you do with a share price, just like you do with the price of the index. Your assessment, your view, your experience is invaluable here. My point here is don't be intimidated by option prices. It's not as if some people in the world have more information than others. It's not as if huge option scientists have some kind of advantage over you. They don't. At the end of the day, all those option prices are governed by market forces, and market forces are all the millions of people around the world, bringing us to some kind of fair value at any one moment.
That's great.
Okay.
That's great. Do you think the international trading community will trade the Saudi exchange derivative products?
Do we think the international trading community will trade Saudi products? Well, of course, I can only offer a personal view in that. I mean, I've worked around the City of London, a major financial district, for many years, and I know a lot of traders. So without being able to answer definitively, my personal view will be yes. I mean, the major stock exchanges have traditionally been located in New York, London, Tokyo. I mean, I think in having access to equities in your part of the world and derivatives in your part of the world is a really interesting development. And I would have thought, yeah, most international investors will definitely look at those products because it just gives you exposure to a vitally important center. Yeah.
That's great. Okay, I'm not going to take a long time, but this is the final question, of course.
Okay.
What is the single most important skill that is needed to be by a derivative trader?
There are two: knowledge and discipline. You need knowledge and experience. Obviously, experience takes a bit of time to get, and discipline. The two, and you need to be resilient. At Zishi, we say, build resilience through knowledge. Resilience is so important. Don't get angry with the market. Don't get upset with the market. To be wrong is okay. It's very important when you're loss making to not reflect on yourself too badly. And it's important to be disciplined. If you are taking your losses, accept those losses and get out and come back. I often compare trading and investing to being a professional boxer. A boxer doesn't get in a ring and expect to knock out their opponent in the first round. A boxer jabs, and they're very careful and they're very disciplined. Trading is very much like that. So you need to be resilient, you need to have discipline, and you need to practice risk management. And you need to plan. You need to be strategic. Don't go for the tip of the day, something you heard from a friend. Do your research.
Perfect. Thank you so much, Mr. Simon. It was a wonderful journey of going with you through all of this. And I hope that we reached all the audience expectations. We have done a very good job today. And thank you so much, everybody. That was Mr. Simon with a very good, important subject, introduction to future and options. Thank you so much. Have a wonderful day.
Thank you to the Saudi Financial Academy and you, Ibrahim. It's been a great pleasure.
Thank you so much. Thank you.
Okay.
Thank you.
Okay. Bye-bye.
Bye.